Have you ever looked at the market, especially, a really hot sector like AI, and you see two companies, right? Both seem great, same tech wave, but one stock shoots up maybe 15%, and the other one, it actually drops 2% on the same day. It happens constantly. And most people probably think, okay, that's just random market noise, maybe some big fund making a weird move. But what if it's not random? What if that big difference, that divergence, is actually something you can measure, something you can track, and maybe even anticipate? Well, that's exactly what we're digging into today. We're doing a deep dive on this really interesting framework called the Behavioral Flow Gradient, or BFG for short. It comes from Devin McClarty at D Investment Enterprise, and it's published through their series like LoopMarket, the financial engine, and it offers this, well, structural view.
Yeah, it's fascinating stuff because it pushes past just looking at the balance sheet. It's designed specifically to map out what they call monetary psychology. So how money, emotion, and sort of the market structure itself interact. The whole idea is to see how investor belief turns into actual measurable results. And it does this by tracking the difference, the divergence, between two really core ideas, faith and dependence.
Okay, faith and dependence. Let's unpack those because clearly the whole framework kind of hinges on understanding these two forces driving capital. What does the model mean by faith? Is it just blind belief?
No, not at all blind belief. That's key. In this framework, faith is market conviction, yes, but it's conviction that's been validated, validated by tangible execution, real proof of delivery. It's belief a company has actually earned through results you can see, results that are repeatable.
Okay, so earned belief.
Exactly. And when a company builds that kind of faith, what happens is institutions tend to reward it. They bring in stable, often long-term capital. The framework actually has a term for this, faith accumulation. It's like capital that anchors itself. And the principle behind it is pretty straightforward. Faith flows toward delivery. It naturally moves towards the proof.
Right, that makes sense. It sounds stable, predictable almost. Faith is capital that's been earned. It moves slowly. So if that's faith, then dependence.
Well, it sounds like the flip side, maybe more like that speculative high-risk stuff. What defines dependence here?
You got it. Dependence is basically market position built on, well, hype. It's the narrative, the noise, the speculative expectation about what might happen rather than what has happened. You're essentially betting on the story, the potential, not the proven performance.
And the risk there is? Well, the risk is its fragility. Capital built purely on expectation is shaky. If those expectations aren't met, say, a company misses its revenue target, a classic example, the withdrawal of that capital can be incredibly fast and pretty harsh. The framework calls this mechanism dependence extraction, and the principle here is the opposite of faith. Dependence follows noise. It chases the hype.
Okay, but hang on a second. Doesn't almost every innovative, fast-growing company start out with a good dose of dependence, people betting on the future? Is it always a bad thing in this model?
That's a really important point, actually. It touches on the nuance. Dependence isn't inherently bad, no. You often need it for that early funding, that initial spark. But the framework really highlights its instability. That's the key difference. See, dependence-driven capital needs constant feeding. It needs the narrative, the hype, the speculation to keep it there. Faith-driven capital, on the other hand, becomes sort of self-sustaining because it's based on results that are already confirmed. So it's really about the quality and stability of that capital, not just whether it's available. And the BFG, this gradient, is designed to show you where that market conviction either solidifies into real proof or just kind of evaporates into emotion and hype.
That distinction feels critical, validated action versus just expectation. Let's make it concrete. How does this BFG framework play out in the real world? You mentioned the AI sector as a sort of test case.
Yeah, the AI space is perfect for this because it's so dynamic. You have companies genuinely delivering groundbreaking stuff today and others making huge promises about tomorrow. It creates this natural tension. The framework looks at each company as its own little ecosystem, a micro-DDI. That DDI basically represents its specific ratio of faith versus dependence at that moment.
Okay, micro-DDI, got it. So let's look at the examples from the research, starting with the faith zone, BigBear.ai. On the day they analyzed, it surged, over 15%?
That's right, a big move. And the analysis pinned that surge directly on the company delivering, and I quote, proof, not hype execution. They showed something concrete, some validated business action. So it's a really clean example of faith accumulation in action. The market saw the proof, and stable capital flowed in, rewarding that delivered result.
Makes sense, rewarding delivery. Now, the other side of the coin, the dependent zone example, Rigetti computing, it fell about 2%.
Exactly. And that drop came right after a revenue miss. So they failed to meet that speculative expectation the market had priced in, and boom, immediate capital withdrawal. That's your classic dependence extraction. It really underscores that inherent instability we talked about capital, tied only to the story, is the first to run when the story falters.
And it's important, I guess, to stress this is a spectrum, right? Not just one or the other. The research mentions other big AI players, NVIDIA, SMCI, AMD, Microsoft. They often sit in these sort of neutral or transition zones, moving between dependence and faith.
Absolutely. It's a gradient, not just two boxes. The whole point is to make this market behavior measurable, something you can actually act on. And to do that, you need to visualize it, map it out. The BFG is designed to be charted, which means that we need to understand that core metric they use.
Right, the DDI you mentioned earlier in micro-DDI, we probably need to know what that actually stands for if we're talking measurement.
Good point, yeah. DDI stands for the Divergence Differential Index. It's a proprietary metric, obviously, but the core idea is it measures the gap between the actual financial result and the underlying investor expectation. It quantifies that divergence between faith and dependence. And this index, the DDI, is what forms the y-axis on their visualization, the AI micro-DDI map.
Okay, so we're mapping monetary psychology. We have a map. What are the axes? What should you, listening, be picturing here?
Okay, think of a simple chart. Two axes, the x-axis, the horizontal one, that's just price momentum. Simple enough, the daily percentage change in the stock price, up or down, and by how much. The y-axis, the vertical one, that's the crucial DDI divergence. It shows where the company sits on that faith-dependent spectrum.
Yeah.
Positive DDI score, faith is building. Negative DDI, dependence is leaking out, being extracted.
Got it. X is price change, Y is the faith dependence score. So let's put our examples on that map. BigBear.ai, price momentum plus 15%, and its DDI divergence was around plus 1.2. That clearly puts it in the positive faith zone.
Precisely. High positive momentum, strong positive DDI, textbook faith accumulation. And then Rigetti, at the other extreme, price momentum, mega 2%, so negative price action, coupled with a DDI divergence around negative 0.8. Negative DDI score puts it squarely in that dependent zone, negative momentum dependence extraction happening. Suddenly, what looked like just random stock moves starts to look like a structured, almost predictable psychological map.
That visual structure is really compelling. And they use a metaphor, too, right, to help make the movement of capital stick in your mind. Something about flowing downhill.
Yeah, it's a great one. Faith flows downhill toward proof. Dependence clings uphill to hype.
Okay, explain that a bit. Flows downhill, clings uphill.
Think about gravity or energy. Capital moving towards proof. That's the downhill flow of faith. It's almost effortless, gravitational, because the results speak for themselves. They validate the flow. But capital clinging to hype, that's the uphill struggle of dependence. It takes constant energy, constant narrative, constant pushing to keep it there, resisting the natural pull of reality. And when that energy, that hype engine, falters even a little bit, extraction, the downhill slide, is the natural, almost inevitable outcome.
That really shifts the perspective away from just looking at, say, PE ratios or revenue growth in isolation. So let's tie this all together. The big picture view from Devin McClarty's research here. What's a fundamental lesson about how markets behave?
Fundamentally, it's about this idea of monetary psychology. The core premise is that money isn't inert, it behaves. It has patterns. And structure, like the BFG, is how you make that behavior measurable. It's about quantifying belief, essentially.
Quantifying belief.
Yeah. By looking at that DDI, that divergence, you're not just seeing a stock price. You're assessing the quality, the resilience of the capital supporting that valuation. Is it sticky faith capital or flighty dependence capital? Capital built on faith. Likely more stable, probably less volatile day to day, and it should hold up better during market stress, during drawdowns. Capital built purely on dependence. Well, that valuation is inherently vulnerable. It's prone to sudden, rapid extraction the moment the story cracks. So it shifts your focus from just guessing the next earnings number to assessing the kind of belief, the kind of capital that's actually holding the price up.
So the structural view gives you a kind of predictive edge then. You're looking for companies consistently delivering proof because you expect conviction and therefore capital to flow there predictably. And conversely, you're identifying those hype-driven situations where the capital is almost guaranteed to vanish quickly when, not if, but when those expectations aren't met.
That's exactly it. The framework forces you, the investor, or anyone making decisions really, to ask, is the money behind this valuation rooted in proven, validated behavior? Or is it just sort of hanging on by the thread of a speculative story? The BFG predicts one path, the faith path, leads towards long-term resilience. The other, the dependence path, leads towards volatility, instability, and potentially significant failure.
Okay, So we've essentially mapped out this monetary psychology, showing how capital flow isn't just random noise. It follows predictable patterns when you view it through this specific lens of execution versus expectation, the behavioral flow gradient.
Yeah.
And just to be clear on attribution, because we have been talking about specific proprietary research here, this whole framework, the BFG, the DDI index, all the related concepts, was developed by Devin McClarty, who founded Structural Intelligence. It's owned by D Investment Enterprise LLC and published through D Publishing Group.
Which brings us neatly to the final thought, the question you want to leave you with as you think about all this. If structure, like the BFG, makes market behavior measurable, then the really critical question to maybe ask yourself is this. What does the measurable behavior of your own investment process, your own decisions, reveal about your personal faith versus dependence ratio? Are you naturally flowing downhill towards proof? Or are you maybe spending a lot of energy trying to cling uphill to hype